Hello everyone, my name is Revi Damayanti from Class AK23A, student number 234120007. Today, I will present a topic that is fundamental in financial reporting, consolidation in the context of acquisition, using the equity carrying amount method. First is understanding consolidation. Consolidation is a fundamental accounting process used when a parent company controls one or more subsidiaries. Control is typically achieved through majority shareholding. The purpose of consolidation is to present the financial statements of the parent and its subsidiaries as one single economic entity. This ensures that users of financial statements get a holistic view of the financial position and performance of the entire group, rather than viewing each entity in isolation. Next, understanding acquisition. An acquisition occurs when one company obtains control over another, either by purchasing a majority of its voting shares or acquiring its net assets. When control is established, the acquiring company must consolidate the acquired entity's financial statements into its own. This process is a key element in forming corporate groups and allows the acquiring company to manage and report the results of its subsidiaries as part of its consolidated operations. Next, equity carrying value method. The equity carrying value method is a consolidation approach in which the parent company records the subsidiaries' assets and liabilities based on their book values, as reported in the subsidiary's own financial statements. This method does not involve remeasuring assets and liabilities at fair value, nor does it recognize any goodwill or gain on acquisition. It is commonly used in business combinations involving entities under common control, where transactions are not considered to be conducted at arm's length. Next, characteristics of equity recorded value. This method has several distinct characteristics. Firstly, there is no revaluation of the subsidiary's assets and liabilities. They are carried over at their existing book values. Secondly, since the transaction is not considered to be a fair value exchange, no goodwill is recorded. Thirdly, the transaction is often regarded as a reorganization of ownership interests rather than a market-driven acquisition. Finally, this approach is most applicable in group restructurings or internal realignments within a group of companies. Next, consolidation process at recorded values. The consolidation process under the equity carrying amount method involves several steps. The first step is to identify which entity is the parent and which is the subsidiary. Then, the parent's investment in the subsidiary is eliminated against the corresponding equity in the subsidiary. After that, the financial statements of both entities are combined line by line, including all assets, liabilities, income, and expenses. Finally, any intercompany transactions and balances are eliminated to avoid double counting within the consolidated financial statements. That's the end of my presentation. Thank you for your attention.